Our restaurant group Famous Brands has reported an almost 10% rise in earnings at the halfway stage of its financial year. This has revenue increased marginally and operating profit remained steady. Africa's largest restaurant franchises' operating profit margins were affected by lower volumes and overhead cost pressures, but the group remains optimistic about the second half of the year. Darren Hele, CEO for Famous Brands, joins us with more insights. Thank you so much for your time, Darren. Now, in the 6 months, was there a clear difference in performance between the two quarters, or did the pressure filter throughout?
Greetings, Anati. Thank you for having me. Yeah, it was very much a tale of two quarters of the half. So, it's interim results, but, for the first time, probably in a long time, we've seen a distinct difference. We don't even normally provide quarterly data. It just hasn't been necessary. But I think given the extremities of the two, and particularly the first quarter was March, April, particularly difficult, and May probably wasn't as bad as one would think given the elections. I mean, it wasn't buoyant, but certainly the pressure came in those 2 months. So, yeah, we've seen a nice recovery in the second quarter, and that has continued. So, yeah, it was interesting. I suspect the consumer was in a tough place. It wasn't just about the election. I mean, Easter was very early this year. We had Ramadan over Easter, and we also had Easter over month end, which is not a great recipe for people getting away, traveling, enjoying themselves either.
Yeah. I mean, listen, there's an air of optimism there, Darren, but still, consumers are still under pressure. And I'm actually just wondering, I mean, talking about continuation of this momentum that you saw in the second quarter. Of course, you want that to continue on to the second half of the financial year. I just want to know from you, what is Famous Brands working on to ensure that that momentum continues, particularly from a controllables point of view, as the macroeconomic environment still does remain tough?
Yeah, look, we're keeping our business as simple as possible. I mean, obviously making sure our value proposition for the consumer is right. And I mean, that's not always easy, but I mean, really, adjusting menus to make sure that we've got the right value points without de-engineering products. So, we're not pursuing a kind of shrinkflation strategy. So, our iconic products are still what they are, but bringing in additional items, also obviously making sure we compete well, but really trying to get that value pricing and value proposition right for consumers at any price point. And I think that people have that need. So, they're not always looking for value in terms of low price. I mean, it's about the proposition, making sure we continue to refresh our restaurants, and our franchisees are investing on that side, investing in technology. And also, continue to open new stores is important. And, we were a bit slow on that in this first half. I think some of it, around delays around the election potentially. But, we tend to push quite a lot in the second half anyway. So we're excited about that and being where the consumer is. And that's the most important.
Yeah. Well, things have changed on the electricity supply front, where we actually have had no load shedding this year. And I'm wondering if that benefit of no load shedding has actually filtered through to Famous Brands' numbers.
Look, there's a little bit of theory there. I mean, the benefit has definitely flown through in terms of the simplicity of running the business for ourselves and our franchise partners. So there's no doubt about that. And we also, as a franchisor, haven't had to provide relief, which we had done. So we still had load shedding in March. I mean, there is a theory around, how disruptive the market is, and consumers do come to us on QSR for convenience when they are hit with load shedding. And we certainly do see that at times when load shedding is at a lower intensity. So, as an example, when it would be off for a while and come in at stage 2 or 3.
Yeah.
But at the kind of levels we were seeing towards the end, that level of intensity, the consumer almost was hunkering down and, wasn't necessarily looking for meal supplements. They were organized. A lot of them have invested in alternative power. So we think that trend towards the back end was lost. We never want to see it again. But if there is ever load shedding, we think we'd benefit from the convenience and the disruption initially, but over time, not necessarily.
You talk about, Darren, of course, not having to provide relief to your franchisees now because there's no load shedding. But are there things, challenges that are keeping your franchisees up at night where you've had to come in and provide support there?
Look, running any business in SA, particularly the past 6 months, is not easy. And a small business, even more difficult, and depends on where you are. But no, outside of the normal relief, in March we provided relief on power. We haven't subsequent to that. And outside the normal run-of-the-mill things which would have been there for years, we haven't had to provide relief. And I mean, we would obviously still do that if somebody had a road dug up in front of their restaurant, or there's some kind of macro factor that's affecting them, we would always try and assist. But that hasn't been out of the ordinary in this period, other than March.
And of course, this is a diverse business, and I'm wondering, I mean, where are the, are there, certain differences that you're seeing between the different restaurant groups, but also your manufacturing, logistics divisions? Where are the highlights and the lowlights there?
Yeah, we've seen a change in mix this past period, which is unusual, and that has had knock-on effect, and that really talks to what I spoke about earlier about value. So in doing that, there are menu adjustments. We've had to rethink some of the way we approach the menu. There's been high food inflation. So that's had a knock-on effect onto our logistics and manufacturing business. We've also seen that our signature brands, which is our sort of boutique premium division, and focused on niche food experiences like in hospitals, steakhouses, etc., has had a much tougher time for a variety of reasons. And people not necessarily been able to shop at that level, and that has definitely cut back. I mean, we've obviously it's a highly competitive category, so our leading brands have done particularly well, and working through that. So I think the change in the menu mix is around the way the consumer is shopping around value, and which is understandable.
Darren, interest rates are being cut and inflation is coming down quite significantly. Even today, we did have the September inflation print dropping to 3.8%. Do you expect the relief from these areas, interest rates and inflation, to start filtering through from this current financial year, or will that be coming from 2025?
No, look, we've already seen some buoyancy in the consumer, since the first cut. I mean, that could just be sentimental, and it could just be other things at the same time, coincidentally. But we think it will start to filter through as it comes, because it's not just around the physical cash that gets freed up, but it's also about people's mindsets and sentiment. So we think that would be, immediate. And again, we're not looking at high ticket numbers. So somebody may still delay buying a new car, as an example, but I mean, a pizza, is a lot more affordable, and of course, you've also got at the same time the two-pot system coming in, and from our perspective, even more exciting is that we have quite a large debt pile in our own business, so that interest rate coming down bodes well for ourselves and investors.
All right. Well, thank you so much for your time and giving us more detail on those numbers that we saw coming out of Famous Brands. Darren, that was Darren Hele, CEO for Famous Brands.